All right, everybody, welcome to DeWitt Capital Management's second webinar. We are really excited to have you here, and we're excited to share with you some ideas on tax planning while you're working and when you retire. So today for you, we have myself, Dave DeWitt, and we have Dave DeWitt Sr., who's a CFP, and Scott Frank, who is a CAIA, KAIA, they call it, and a CPWA. I think I got that right.
Yes.
You might want to tell us what those mean.
Yeah. One is an analyst for alternative investments, and then the second is a certified private wealth advisor.
Yeah, I'm a CFP, which is certified financial planner, and a MBA, and I have a CSRIC, which stands for Chartered SRI Consultant, which is sustainable investing certificate.
Yep. And we are financial planners, and we have been helping people plan for retirement since the day Jesus died, I think was the joke we said earlier. So it's been a while.
Been a while. That's because of me.
Yes, of course.
Because I'm the old one here.
Right. All right. So let's hop right into this. Here's some disclosures. All right. So what are we covering tonight? We're going to be talking about tax planning. And the goal of tax planning really is to minimize your tax liability using tax breaks. And this is done through careful analysis and evaluating all elements of your financial picture. It's really important to know that with retirement tax planning, you're really not trying to plan for minimal taxes in any given year. You're trying to sort of take the big picture and say, okay, from now until I retire, how can I plan so that I'm over the course of the rest of my life into retirement, how will I pay the least amount of taxes? So for example, if you were going to pay a minimal amount of tax this year, but it was going to cause you to have to pay a lot more tax in the future, it might not be a great idea. So it's looking at the big picture, and a key principle of effective tax planning is to really try and pay the most tax when you are in the lowest tax bracket. So in order to do tax planning, we take into account the timing of income, the selection of investments, type of investment accounts, current tax law, and more. And tonight we're going to talk about reducing taxes through retirement investing, ways to reduce taxable income, and setting up tax-advantaged income in retirement. And finally, maximizing Social Security benefits.
Yeah. So a great way to reduce your tax liability, particularly when you're working, is to utilize something called the 401k. With the 401k, you are actually contributing on a pre-tax basis. So what does that mean? We have a nice little illustration for you. So say you have a couple filing jointly. They earned a combined income of $150,000, and they each contribute the maximum $19,500 per. Let's assume they're under 50. So the total pre-tax contribution they're making for the year is $39,000. So what that $39,000 is then doing is it's lowering their 150 to effectively 111 or 111,000, and then their tax payment is roughly, call it $10,000. So on an effective tax rate, it's a little over 9%. If they weren't contributing, obviously then there would be taxed at the $150,000 level, which would then equate to approximately $18,000-$19,000 for an effective tax rate of 12.6. So you can kind of see how by contributing, you're putting money aside for yourself, but also reducing your taxable income by, in this instance, as a generic illustration, $8,500. This obviously assumes a standard deduction and no company match, but you can kind of see the power of putting money away pre-tax can help reduce the tax burden today while you're working.
Yeah, for sure.
And I guess we could point out that if you're over 50, you can raise that up to 26,000, which would make it better.
Yes. I think, Dave, we can move to the next.
Okay.
Cool. So now let's go to the other side of the coin, which is once you're retired. So a recent study was done and found that approximately 60% of Americans don't really consider taxes they will pay or will pay when they're in retirement. So I think what we want to kind of point out here is once you hit that retirement date, there will be a number of sources of income you'll be pulling from. So some of the most common here we've described. So Social Security is one. Now with that, up to 85% of it will be taxed. Depends on, there's a certain threshold there. So you do get a little bit of advantage there that you got that 15%, assuming you hit the 85, will be non-taxed. Most people, as mentioned in the previous slide, will have some type of 401k or IRA as available capital to withdraw from. These are taxed at ordinary income tax rates when you take them out because they were funded pre or tax deferred, call it. The Roth IRA is another option. The monies that go into Roth IRAs are after tax and can be withdrawn without tax. Pensions, for those who still are eligible for those or work for companies that still have a pension, that's another taxable income to consider. And then lastly, we have here is a taxable investment account. So think of your traditional brokerage account. Those hold stocks and bonds, and you're taxed based upon any kind of interest income or dividends or capital gains when you go to sell something. I think maybe what we should have put, but for those who are prepared or maybe will do some type of part-time employment or maybe a hobby job in retirement, that also needs to be considered. So all these things kind of combined need to be reviewed and looked at as that does affect your effective tax rate once you leave the workforce.
All right, so diving a little bit more into 401ks, IRAs, and pensions, as Scott did mention briefly, withdrawals on 401ks and IRAs and pensions are fully taxable in most cases, unless the contributions that you made were non-deductible. Then only the earnings portion of the withdrawals will be taxed. But for the most part, on these pre-tax vehicles, you will be paying tax. Now, on the Roth IRA, as long as when you contribute to a Roth IRA, as long as you don't touch the money for 5 years, all of the withdrawals from the Roth IRA are income tax free. Some more details on pension payments. With pension payments, you owe federal income tax at your regular rate for pension annuities and payments. If taking a direct lump sum payout, you must pay the total tax due when you file your return for the year you receive the money. And then one really important thing we wanted to put in here is the Roth conversion. So this is really, really important for a lot of people. So if you don't qualify to be able to contribute to a Roth IRA because you exceed the income limit, you can use your pre-tax IRAs and convert them to Roth IRAs. You will pay income tax on the amount you convert, but then the converted balance is able to grow tax-free. So if you're someone who doesn't have a lot of tax-free savings to use later on in retirement to help manage your taxable income in retirement, this can be a really, really great tool. And this can help manage taxes, like I said, later in retirement for before RMDs, required minimum distributions, and Social Security starts hitting.
I would like to maybe just point out here that you would ideally do your Roth IRA conversion in a low tax year. So maybe, when your tax bracket is the lowest, if you can do the conversion that year, anticipating maybe higher taxes down the road, that's when you would try to do that.
Yeah, for sure. So taxable investment accounts can also be very, very important. So with the taxable investment accounts, just your standard brokerage account, you will pay tax on dividends, interest income, capital gains. But you have so much more flexibility in terms of what you own, how you own it, and you're not in a partnership with the IRS. Essentially, you're not going to have to pay income tax when you make a move. You might have to pay tax on gains or interest or dividends, like I said. But using a combination of pre-tax, so your IRA, your 401k, Roth, and taxable gives you the most flexibility as you're starting to think about entering retirement. And this is when I think the Roth conversion can come in really handy. So if you're someone who wants to delay Social Security until you're age 70, because for 95% of cases, that's the best thing to do. There's going to be maybe you might have, let's say, 8 years of a gap between when you retire and when you take Social Security. And if you have flexibility where you have substantial taxable assets without humongous gains, or even if there are some sizable gains, you can then manage your taxes in those 8 years and keep yourself in a low tax bracket. And then while you're doing that, you can then convert your pre-tax slowly through those 8 years to a Roth IRA. And that way, when you finally start taking RMDs at age 72 and Social Security, you're going to have this onslaught of taxable income. You're then going to have a lot of tax-free income flexibility to still keep your tax bracket managed. So just like we diversify our investments, diversifying the accounts, the tax treatment of the accounts you use is also really, really important.
So, something to keep in mind is when do you start taking your Social Security payments? And the earliest you can take it would be age 62, and the latest you can take it is age 70. Your full retirement age would be age 60. That gradually goes up for a few more years to age 67. That would be a few years down the road. But let's say if you take it at age 66, that's your full retirement age. You're going to be able to increase the amount you can take out once you reach, at the top, age 70. So taking distributions from a tax-deferred account, such as an IRA or 401k, can allow you to delay your Social Security and maximize your benefit. There's another advantage. Tax-deferred accounts have required minimum distributions that kick in at age 72. These are based on the value of the account and are taxable income. So getting your income from other sources other than taking it out of your 401k, if you have a traditional brokerage account, it can live off of dividends or capital gains. Try to do that as much as you can. Lower the value means lower RMDs, which can give you more control over your level of taxable income. So the less that you have in your IRA, the lower your required minimum distribution would be. So just for a point of clarification, your Social Security is going to be taxed at 85% of your Social Security will be taxed if your income is at $44,000. That's for filing jointly. So a lot of people would be paying 85% of their Social Security income will be taxed. And so again, I'd like to emphasize that if during that interim, if you can postpone your Social Security starting at age 70, you will get the maximum benefit. So if we go to the next slide, we can talk about how that works. So this will illustrate what happens to your income. And this is for an average wage earner, the maximum that you can get today at age 70 is $3,895. In this illustration, it's $2,640, which means that the earner was not at the top level. Here at age 66, the income is $2,000 a year. And starting at age 62, you could start Social Security, but your payment will go up 8% per year every year until age 70. So, if you think about your longevity, if you think about, and here's a slide that shows you exactly what it is. So full retirement age benefits at age 66 and 2 months, you get $3,148. This is at the highest level. At age 70, it's $3,895. And if you start at age 62, you're earning $2,324. So again, if you can find a way to get your income from other sources than your Social Security, and you can begin taking Social Security age 70, and you feel like you have, good longevity in your family and your health is good, then it would make sense to postpone that, beginning your distributions till age 70.
Yeah, I think there's been a lot of studies out there that show that it is almost always optimal to wait until you're 70. A lot of people will say, well, wait, what if I die when I'm 75? I only get 5 years of it. Well, I think that might not be the right way of thinking about it. It's better to think about it as insurance in the sense where you wouldn't root for your house to burn down because you want the insurance money. It's the same with this. The risk, the bigger risk is you living till you're 95 or 100 and running out of money as opposed to dying at 75 because we can't really predict the future. So think of insurance as Social Security as more like insurance, and try and maximize that benefit as long as you can. Again, like Dave said, if there are some cases where taking it early makes sense, but in most cases it'll be taking it late. Okay, so for those of you that are self-employed, saving is a little different. You can use the SEP IRA, and the contribution limit for that is 25% of compensation up to 57,000, or a simple IRA, which is 13,500 under 50 or 16,550 plus. And these are, tax deductible ways of saving for retirement that'll help manage your taxes as you're saving for retirement. And then, of course, we have the traditional IRA, where under 50 you can save 6,000 per year tax deductible contributions, and 50 plus 7,000 tax deductible contributions. Do you guys have anything to add to that?
I would just say that, you can have a SEP IRA and a traditional IRA, and you want to talk to your tax accountant to talk about that. But it's important to keep in mind that if you're over 50, that you can bump up your contributions to the simple IRA and to your traditional IRA, and also take a look at, where you can contribute more to your 401k as you get older. These are things to keep in mind.
Yeah, for sure. And then there are a couple other ways you can save in a tax advantaged way for retirement. You can use an education savings account. There is an income limit on that, $2,000 per child up to $190,000 in income. And with this, the dollars are actually not tax deductible, but it is a way to basically get yourself a tax deductible, or a non-deductible IRA, where you're getting the tax deferral on the growth at least. And then if you take the money out for education expenses, it's tax free. There's also the health savings account, which you can contribute, and they are tax deductible. Under 55, you can contribute $7,100 per year. 55 plus, another catch-up provision there, $8,100 per year, tax deductible. And with the health savings account, it's funded with pre-tax, grows tax-free, and there's no tax if you withdraw it for qualified medical expenses, which there's a higher likelihood of that happening, of course, in retirement and in your later years.
And using a health savings account allows you to buy a health insurance with a high deductible, because this money is available to pay the average expenses of going to the doctor or routine visits. And so in the event of some sort of emergency, then the high deductible will kick in, but you should have saved up some, if you actually have to use it. So it's a great way to supplement your insurance and not pay tax on that money as it grows.
Then another thought process here is something called asset location. So as you plan out your distribution phase of your assets in retirement, the location of the assets matters. So how do you fund it? What kinds of accounts, the types of investments that are held in accounts, they're all taxed differently. So in essence, based upon your income level for the year, as Dave had mentioned previously, you can decide on which accounts to draw from. So if it's a higher income year, you may want to utilize investments from a taxable account. And in lower years, you could utilize it from a tax deferred account. And the whole thought process behind that is, in the tax deferred accounts, investments are withdrawn or capital is withdrawn and paid on ordinary income tax base. And then on the taxable, you just paid on either at a dividend rate or the long-term capital gain rate, assuming you hold it for a year. And as you're kind of in retirement, where you place assets or the types of strategies or styles of investments, some of them are inherently or naturally more tax efficient. So if you think about something like a municipal bond, which gives us tax-free income, or tax-exempt income, I should say, index funds that don't turn over a lot or don't trade a lot, and then stocks you intend to hold for more than 1 year, all those things are fairly tax efficient. And you're only really taxed principally on any adjustments you make to them. Assets that have less tax efficiency would be things like fixed income, which is giving you sort of interest income, which is taxed at a regular rate anyway. Commodities, alternatives, or anything actively managed, as there's more trading or more turnover, as we say, and those tend to trigger more short-term tax events. So these are all considerations as you hit retirement and then are in retirement, kind of where you've placed assets to maybe provide another level of tax efficiency. And then the last thing to note is the benefit of the Roth IRA, as discussed already, is that those assets can be withdrawn tax-free. So depending upon what type of year you're going to have from the income perspective, you can really start to toggle and dial in where you want to withdraw capital from.
So I want to add something about the tax deferred accounts here. So either in a Roth IRA or regular IRA or SEP IRA, taxable bonds that have the highest yield are fully taxable at federal, state, and local levels. So there you get the benefit of being able to take that income, and it's going to be taxed at regular income when you take it out, but it's going to grow tax deferred, and you can no matter what you put into a tax deferred account like an IRA, even if you put in municipal bonds, when it comes out, it's going to be fully taxable. So take advantage of getting your highest returns from corporate bonds and fixed income by putting that into a tax deferred account. And also, if you have an if you're actively trading your account or have a manager actively trading your account, all those short-term capital gains that would drive you into a higher tax bracket can be executed within a tax-deferred account. So if you're doing short-term trading or have a manager working for you that does short-term trading, that's a great place to put into a tax-deferred account like an IRA or SEP or Roth.
Yeah, for
and
sure.
It says so. I mean, on the sheet, it says actively managed strategies, and that's what that means.
Yeah, and also a great place to put your most highest conviction or your growthiest assets would be in a Roth, because if you're going to get a lot of growth, you might as well get it tax-free.
Yeah. So if you have like a company you have a complete strong conviction on, or a mutual fund or a manager that you really believe can really outperform, that would be a great place to go with a Roth IRA.
Yeah, for sure. All right. So we're getting to the end here already. So unfortunately, but let's go through this case study. So here we have Steve and Jennifer. Their occupations are operations manager and media planner. They have 1.1 million in retirement savings, and they're 7 years from retirement. They have 700,000 of total 401k balances. They have $400,000 of Roth IRA, and they have 300,000 in their taxable account. So far, this couple has clearly done a great job investing and saving, but they do need to evaluate desired retirement income, need to get an overview of their full financial picture, and evaluate future tax situations. And they're starting to think about leaving an inheritance. So Steve and Jennifer decided to acquire some help for this and came up with a plan with a financial planner to utilize catch-up contributions to max out their 401k until retirement. Their desired retirement savings is 1.5 million. Their savings needed is 400,000 or 57,200 annually. And they want to begin reducing risk through higher allocation towards bonds and fixed income. For Social Security, they're estimated to be getting $3,700 per month if waiting until age 70, and only $2,800 if it began taking withdrawals at full retirement age, resulting in $10,800 in extra in annual income. So the outcome here, The planner helped them reach their savings goal through 401k catch up and IRA contributions. They can take income early if necessary from taxable account, and their Social Security is going to be delayed to 70 to optimize it with initial retirement income coming from retirement accounts. Do you guys have any color to add to that? Pretty straightforward case study.
It looks pretty efficient to me, and it looks like just doing a little bit of planning can make a big difference.
Yeah, it looks like we had a question come in about backdoor, what a backdoor Roth contribution is. Dave Senior, do you want to take that question?
Yeah, I love to talk about this kind of stuff. All right, so above a certain income level, and I'm thinking it's around $190,000 for couples filing jointly. That could be different because it changes every year. But once you're over a certain income level, you can't contribute to a Roth IRA. However, you can contribute to a regular IRA. So what you could do is just make your regular contribution to an IRA, $6,000 or $7,000, and then you can just convert that to a Roth IRA. And the effect of doing that is the same as if you just contributed directly to the Roth. It's kind of silly that there is this rule that you can't contribute over a certain income level, but you still can do it just by creating a regular IRA, contributing to a regular IRA, and then do a Roth IRA conversion, and you've essentially just, contributed to a Roth IRA. That's what's called a backdoor conversion. It's just an extra hoop you have to jump through, but you can still contribute to your Roth by doing it that way.
Yes, it should be noted, though, that there is tax legislation on the table to get rid of the backdoor Roth conversion. And I think it's for everyone. I don't think it's for just high income.
Do it now while you can.
Yeah. So that's that. It looks like there are no further questions. Okay. All right. So with that, looks like we did it under 30 minutes, which is, I guess, pretty good. So good job, team. I did want to just let you know that if you have any interest whatsoever in having us do a free retirement assessment for you, you can go to dewitcm.com/free, and you can sign up. And you'll also be able to see a sample of what it might look like on there. And also, I might as well plug the podcast too. Check out the Invest Smarter podcast. You can go to dewitcm.com and scroll down till you see it, or use the navigation at the top of the webpage, or go to investsmarterpod.com.
I'm going to put in a plug. Some of these podcasts are interesting, and there's one coming out next week. I believe, David, isn't there one coming out next week? That's on
Monday we'll have one coming out on the tax legislation that's on the table. And I also talk about that story about Evergrande, the Chinese property developer that caused that volatility earlier this week, and also some interesting articles on how earnings conference calls are sort of indicating what corporate America is thinking about inflation. So just some interesting stuff. So check it out.
Okay, I guess, is that a wrap?
Yeah, and with that, I think that's a wrap. All right. Thanks, everybody, for joining.
Have a great afternoon. Have a great evening, and enjoy the rest of your night.
All right. Bye-bye.
Okay.